Bill, good morning. Thanks for being on the show.
Oliver, good morning to you.
Equities just once again starting off, taking a hit right on the chin. Where do you see an end or any light at the end of the tunnel?
Well, I think, I think a big problem here, leaving aside geopolitical stuff and tariffs and everything else, is that the Mag 7 stocks just have become way too big a part of the S&P 500 itself. And so obviously that helped in years like 23 and 24. But you look at this year, before today, right? The S&P, or excuse me, the Mag 7 stocks were down, I think, 10%, and basically accounting for the entire reason why the S&P was in negative territory. And historically, it's somewhat unusual for the S&P to be dominated to the degree that it has by a handful of stocks. I mean, I think the top 7 stocks accounted for 35% of the index at the beginning of this year. Obviously, that's down a lot, but historically, equal weight tends to outperform the S&P over time, and I think that we're now starting to see the beginning of an environment, or maybe we're well into it, where there's more breadth in the market and there's more down cap participation.
So this is kind of a way of normalizing what had been an abnormal situation with all the market cap concentrated up top. I think that's just kind of a natural way to break things up.
Yeah, I mean, look at the relationship between, say, the SPY and the RSP going back since the RSP was created, which was like,
equal weight.
I think 32, yeah, the equal weight, 30 years ago or so. And generally speaking, well, actually, since inception, the equal weight has actually outperformed the market cap weight. And the two major periods of time where that wasn't the case were, of course, 23, 24, which was absolutely, dominated by market cap weight. And then before that, it was basically the .com period. But I think after .com, for 16 straight years, the equal weight actually outperformed the market cap weight by something like 300 basis points annualized. So the more, to your point, Oliver, the more normal environment is actually an environment of breadth and down market participation. And, for the last few years, healthcare didn't do well. Now it's probably, I think, might be the top performing sector in the economy right now. And I think we're starting to just kind of revert back to a more normal environment.
Well said. Pretty sure it is. Healthcare on the year right now is up almost 9%. So it's been a pretty solid, steady bid there. So these things then, do they require a more specific degree of just security-specific allocation within equities? Bill, can we accomplish what we need to just by maybe taking that equal weight like an RSP, or should we be in really concentrated stock or factor-specific positions?
I think being active makes a lot more sense than being tethered to a market cap weighted index right now. Stance Capital is part of the Hennessy family of funds, which is 17 funds, $4.5 billion of assets, all high conviction managers. Each manager might believe very different things, but the point is, I think this is a time for conviction and a time for downside protection. And I think as one of your guests was on about 20 minutes ago, I was listening in, and he made the point, look, in every environment, there's winners. And in our own portfolio this year, STNC, before today, we were actually even for the year. Actually, we were slightly up. So significantly outperforming the S&P. And significant exposure down cap. I mean, I think it's not unusual for us to have positions that are, market cap of 30, 40, 50 billion, as opposed to, some of the mega cap names. And those are the ones that are actually doing well. Staples, healthcare, smaller cap names.
A few of the stocks, correct me if I'm wrong, but as of last update, Wells Fargo's in there, Apple's in there, BNY, AT&T, Deckers, which was a big runner, and then came back this year. It looks like there are a few in there that are very interesting to me. One is Apple. Do you think Apple can hold on the way it has so far as almost being like one of these anti-beta trades? Apple has been steady as it goes, basically. Even though it trades at near, I mean, it just came off an all-time high valuation. How long can it hold up as a pillar, do you think, Bill?
Well, to be super clear, Oliver, actually, your data is a bit old.
Is it? You guys at Apple?
Yeah, we don't have Apple right now. And in fact,
wow.
most of the names that you threw out, we don't add or we don't own because we're a systematic shop and we rebalance quarterly. But to answer your question specifically,
sure.
And I would rather own Apple than Tesla. I think Apple is, in fact, a pillar, whereas I think Tesla's, entire valuation is basically brand driven. And while that helped it during sort of like the cycle where its clients and its customers were concerned about environmentalism, I think there's a lot more pain ahead for a name like Tesla, because I just think fundamentally they're in a very, very tough spot. Whereas I think Apple has some challenges around trying to find kind of the next set of products. They probably wish they had stayed in the EV space at this point, but who knows?
Hey, Bill, on another sector, banks, financials, I guess Morningstar has got to be a little more active with their data. Tell me about financials. What role do they play in your portfolio right now?
We've got a handful of regional banks. We've got a few bigger banks. I think really for the first half of this quarter, banks were doing great. Financials have, in general, been doing pretty well. We also own Visa and MasterCard, which within financials is probably the best performers within our portfolio right now. I think since the trade war, since the tariff stuff kind of got ramped up about 30 days ago, I think a lot of banks have taken a hit on that and just concerns about the economy slowing down in general. But I'm not terribly worried about financials. Weirdly, I think, well, not weirdly, but, Trump's sort of anti-regulation crusade actually, I think, helps a lot of the financials, especially the banks.
Okay. So I guess they have been trading solid for a reason. A group that you think maybe can almost act as kind of a hideout?
Yeah, I mean, I would rather hide out, frankly, in staples or in healthcare right now.
Love it. Bill, thanks for the thoughts. Appreciate it very much.
All right. Thanks, Oliver.
Great stuff. Helpful conversation. Like the context on the sector, specific stock, specific stuff.